Welcome to the Roundup, covering what's important for accountants and advisors across the month of November. Inside this month, the ATO's update on family trust elections. We'll also look at the last-minute bill frenzy by the Senate just before the end of the calendar year. But first up, the final guidance on Section 99B. Now, Michael, the ATO has finalised its guidance on specific provisions dealing with trusts. Can you remind us what these rules are designed to do and what we need to look out for?
Yeah, those provisions that we refer to are contained primarily in Section 99B of the old 1936 Act. And while they're not necessarily strictly applicable to foreign trusts, at a practical level, it's when we encounter foreign trusts that we really need to consider the possible application of these rules. Now, earlier this year, the ATO released some draft guidance around the application of Section 99B, and the ATO has now finalised that guidance, and that guidance comes in two forms. There's a tax determination, which has been finalised, and also a practical compliance guideline, which offers, I guess, I wouldn't call it a safe harbour approach, but a low risk, low compliance kind of risk approach that the ATO is suggesting for a couple of different scenarios. Basically what Section 99B does is it says that if you are a beneficiary of a trust and you are a resident of Australia at any time during a particular income year and you receive a payment from that trust, then that payment is accessible to you, unless you qualify for certain exemptions or exceptions. Now, the main exception that we would tend to focus on in practice, and this is where the ATO guidance also kind of delves into, is where that payment is sourced from the corpus of the trust, so the capital of the trust. However, there's an exception to that exception, which basically means that if you receive a payment from a trust, and the payment can be traced back to income or gains made by the trust, which have not been taxed in Australia yet, but they would have been taxed in Australia had they been received by an Australian resident taxpayer, then you basically will end up being taxed on that amount generally. So Section 99B looks at, have you received something from a trust, your residency status across that year, and also looking at the nature of what you have received from the trust. Now, if Section 99B applies, not only are you assessable on the amount that you've received, subject to any exceptions, but there is also an interest charge that can apply. And the way that interest charge works depends on the other country. So what country are you dealing with? Where's that foreign trust based, for example? If you receive an amount from a listed country, a country that has a tax system a little bit like Australia, then you'll tend to find that the interest charge rules are a bit less harsh. Otherwise, you could end up with not only a taxable amount based on what you've received, but also an additional interest component as well. Now, Section 99B is something that maybe in the past, going back a while, it wasn't necessarily something that we saw being relevant all that often, but I've got to say that we're seeing so many more scenarios these days where Section 99B really needs to be carefully considered. And that is due to a whole range of reasons, but generally due to, I guess, a little bit more mobility between countries. So where Section 99B could be relevant for your clients, for example, your clients might have family members who have trusts overseas and they're providing what they call maybe gifts to your clients here in Australia. You might have a client who worked overseas for a while and some contributions were made into a foreign pension fund or retirement savings fund, and they're now taking money out of those funds or receiving money from those funds. You might need to consider 99B. You might have a client who used to live overseas and had some investments or business activities overseas, and maybe they've utilised trust structures as part of those activities. Now that they're based in Australia, they might want to, I guess, distribute amounts that relate to maybe prior year profits, prior year gains that have been accumulated in the trust overseas. All of those scenarios are scenarios where we need to really carefully consider Section 99B. So a provision that sometimes goes a little bit unnoticed, but I guess the hope is that with a bit of focus being placed on this by the ATO, practitioners and clients become a lot more aware of when Section 99B could apply and how it actually operates in practice.
So what are some of the practical things that have come out of the ATO guidelines?
Yeah, there's a whole range of things that we could talk about when it comes to Section 99B and practical issues we need to consider, but let me just kind of touch on two things that I think we really do need to keep in mind. The first one is, I said earlier that we're not really going to call it a safe harbour, but the ATO in the final version of the PCG has set out two scenarios, reasonably common scenarios, where the ATO has indicated that they would consider those scenarios as low risk from a Section 99B perspective. Now, that doesn't mean that Section 99B doesn't apply or that you wouldn't still really be seeking to self-assess Section 99B, but it's basically the ATO saying that they're not going to apply compliance resources to certain scenarios where certain conditions are satisfied. One of those relates specifically to deceased estate scenarios, and this is a situation where Section 99B can very easily apply. If you have a client who is an Australian resident and they are a beneficiary of a foreign deceased estate, when they receive distributions as a beneficiary of that estate, there's a number of different ways that could potentially be taxed, and one of them is under Section 99B. However, the ATO has said that if certain basic conditions are satisfied, the ATO won't apply compliance resources to seek to apply Section 99B to that scenario. Now, while this isn't an exhaustive list, just to give you a picture of kind of what you need to do to qualify as low risk, firstly, the distribution you receive from the estate needs to be received within 24 months of the date of death. So that's kind of the first main practical condition. The second one is ensuring that the total amount that you receive from the estate, whether that's in a single lump sum amount or in a series of amounts, must not exceed $2 million in Australian dollar terms. So there's a bit of leeway there, but just a couple of conditions we need to keep in mind. Now, this is only relevant when we're dealing with a non-resident deceased estate, where the deceased individual was a non-resident just before they died. Now, I do want to just kind of point out that even if Section 99B doesn't apply, that doesn't necessarily mean that those amounts received from the foreign deceased estate will be tax-free. There are other provisions in the tax system which you would still need to consider, including our basic trust assessment rules in Section 97. If you've received a payment from a foreign trust and it relates to some current year income that's been received by that trust or estate, well, you could still be potentially taxed. The other thing that I think is really critical to understand here is that I said earlier that when we're looking at Section 99B, there is an exception to 99B for situations where you receive a distribution that represents trust corpus or trust capital, but only to the extent that that does not relate to income or gains that haven't yet been taxed in Australia, but would have been taxed in the hands of an Australian resident. So what we need to do to apply those exceptions is to understand the source of the distribution that's being made to the resident beneficiary. Now, sometimes that won't be too difficult to do. If your client is a controller of the trust or is closely related to someone who controls that trust, they may well be able to access sufficient information and evidence to prove the nature of the distribution that they've received. But that won't always be the case. And we've encountered lots of situations over the years and had lots of queries from our help desk, kind of through our Knowledge Shop members, where people have really struggled to gain access to sufficient information to prove the nature of the amount that they've received. They've made attempts, they've contacted the foreign trust or pension fund, whatever it might be. They simply haven't been able to access the information that they need to be able to basically apply the carve-out to Section 99B. Now, that's really bad news because in the finalised guidance, the ATO says that the onus is on the taxpayer. If you want to apply an exception to 99B, particularly around the trust capital exception, it's up to you as a taxpayer to gather sufficient evidence to be able to prove that to the ATO. If you can't gather the evidence, the ATO will assume that the amount is taxable and taxable in full. So it's on you as the taxpayer. And even though you might have made genuine attempts to find the information, if you can't get it, then really the ATO is saying that's too bad. It's not the ATO's problem. They're going to basically seek to assess you under Section 99B almost as a default position. Now, we had asked the ATO to maybe consider implementing maybe some additional kind of low risk scenarios or maybe a safe harbour approach in terms of how we might determine the capital amount or the kind of the taxable amount. The ATO has decided not to follow that kind of suggestion or not go down that path, which is a bit unfortunate. So it really is up to us just to make sure you're aware of the risk around that. So be really careful with Section 99B. Be on the lookout for situations where clients are receiving anything at all from a trust that has been a non-resident at any point in time, because that's where the risk of Section 99B really is alive.
While we're on the theme of trusts, the ATO have tidied up their guidance on family trust elections. This is a really confusing area and one where a lot of people get it wrong. And let's review how FTEs work and how you might go about making one, just the abridged version.
Yeah, so the Family Trust Election Rules, which can be found in Schedule 2F of the 1936 Act, were introduced to provide certain tax concessions to family trusts that are typically harder to access for non-fixed or discretionary trusts. For tax purposes, a family trust is one that has made a valid family trust election and passes the family control test. It's not sufficient to just include the words family trust in the title. You actually have to make the formal election. Trustees can make the election as part of their trust tax return or by lodging a separate form that's available on the ATO website. The FTE must name a specified individual whose family group is taken into account for the election, and the person must be alive at the time of making the election. It is possible to make a retrospective family trust election by specifying an earlier income year to commence from. However, this can really only be done if from the beginning of the earlier year until 30 June of the year before the election is made, the family trust passes the control test, and also the trustee has only made the specified individual or members of their family group presently entitled to any of the income or capital of the trust. Once made, the family trust election can only be varied or revoked in limited circumstances, so it's important that you consider whether the election should be made in the first place. One of the main benefits of making a FTE is that it's easier to pass the trust loss rules for family trusts. Normally, non-fixed trusts need to go through 4 different tests, whereas there is a concession for family trusts, so that you only need to pass a modified income injection test. Also, when you're applying the company loss rules, the FTE can help because it allows for tracing through the family trust as a single notional individual when you're applying the continuity of ownership test. Additionally, if franked dividends are passed through a discretionary trust without an FTE, the beneficiaries typically can't pass the holding period rules and access the franking credits. But with family trusts, there are concessions in the holding period rules which allow them to be passed as long as the trust has held the shares for the required 45-day holding period. Family trusts are also exempt from certain trustee beneficiary reporting rules and can access concessions when applying the small business restructure rollover.
So what are some of the limitations that clients should be aware of when making family trust elections?
The main limitation to be aware of is family trust distribution tax, which applies to distributions made outside of the family group at the top marginal rate of 47%. Technically, these distributions can still be made, it's just that they will have a special tax applied at 47%. Schedule 2F defines distributions very broadly to include trust distributions, but also includes things like transfers of property, loans, and debt forgiveness. It's also important to note the definition of family in Schedule 2F doesn't cover all family members. So, for example, distributions to aunts, uncles, and cousins of the specified individual are not covered, meaning that any distributions to them would be subject to family trust distribution tax. It's also important to be careful when making distributions to other trusts and companies. For another trust to be part of the family group, it needs to also have made a family trust election with the same specified individual, or it can make an interposed entity election linking it to the first trust. As for companies, it can be a part of the family group if it has one share class and all shares are owned by the specified individual, their family, or trusts with the same specified individual. Or alternatively, if the company makes an interposed entity election linking it to the trust. Where we sometimes see issues is where 2 trusts have different but related test individuals. So for example, a father and a daughter, which then make an interposed entity election to be within each other's family group. So the way that it works is that if a trust has made a family trust election with one individual, and then it makes an interposed entity election linking it to a trust which has another specified individual, This essentially limits that trust to distributing to entities that are within the family group of both those individuals. Otherwise, family trust distribution tax will be triggered. So where we sometimes see issues is if those trusts also hold interests in subsidiary companies, it may be problematic for the companies to come within the relevant family groups, even though the two individuals are related. In practice, we try to ensure that all related trusts have family trust elections with the same specified individual rather than relying on interposed entity elections. However, as mentioned, the specified individual needs to be alive at the time you make the family trust election. So this is something to be aware of when succession planning, when you think about extracting wealth from existing trusts to the next generation of family members, which may want to set up their own companies or trusts. So given that any mistakes can be very costly for clients, it's also important to review any proposed distributions each year for family trust distribution tax risk before they are made.
And finally, the Senate frenzy that pushed through 32 bills on the final sitting day of the calendar year. Noteworthy for the profession, some of the changes are the objective of superannuation. Now, this objective is enshrined in legislation, so all changes to superannuation going forward will need to be measured against that objective. We've also got the foreign resident capital gains withholding changes, a change in the amendment periods for SMEs, and now the ATO will be able to retain refunds. With the anti-money laundering bill, this bill is important to the profession because it draws the profession in. So accountants and lawyers will have obligations under this bill that they didn't have before. We've also got the aged care bill. Now, this bill enacts some of the reforms recommended by the Royal Commission, but we also have the build to rent incentive coming through. In tandem with that is a series of integrity measures to protect that particular initiative as well. And finally, the restructuring of the Reserve Bank of Australia. Quite a controversial one, but that has also gone through. What was not there was the extension of the instant asset write-off announced in the budget. Here we go again with another thing for small business that is not in these particular provisions. That was removed at the last minute by amendment and is supposed to come back in a different bill in the new year. So we'll see on that one, probably around the budget. What also wasn't there was Division 296. Now, this is the $3 million tax on earnings in a superannuation fund that was announced and supposed to commence on 1 July 2025. That now is well and truly on the back burner, and we suspect until well after the next election. But that is the roundup for this month and also the roundup for this year. So we'd love to talk to you in the new year in 2025 and see what we can do together to help your practice really excel in the new year. We'll look forward to talking to you soon.